If you go to the website of Transparent Value, the interesting thing is that you won't find anything. Hi guys, and welcome to another video by MentorMe's YouTube channel. My name is Alan Arvindan, and today I am back with another interview preparation video. But this time we are covering a new company which is called as Transparent Value. Now, if you go to the website of Transparent Value, the interesting thing is that you won't find anything, right? Because there's very little information that Transparent Value actually gives in terms of the roles and responsibilities and what exactly they do. Compared to that, obviously, it does not mean that they don't have any operations. In fact, they have operations across cities. And in fact, the job quality is also at a very high standard in terms of research. Right? But probably because of some data privacy issues with their clients, the information which is presented on the website and on various job sites are pretty less. But having said that, we were able to still find out what are the kind of qualitative questions which Value tries to seek from the candidate side, and that's exactly what we're going to be covering in this video. So let's get started with the first aspect is to show you on what exactly are the role briefs. And instead of just speaking about the interview process itself, we're going to actually look at some questions which have frequently found their way into the Transparent Value interview, right? So first is, what is Transparent Value? So Transparent Value is basically a KPO, a knowledge process outsourcing center, and majorly into research. Okay, and I feel that over the years, Transparent Value hasn't actually changed the domain. Unlike a lot of other companies which were previously into research, but probably because they were not competitive, they also got into other fields. But Transparent Value has been into research since the beginning, right? So that's the information that you actually just see on their website or on any of the job sites which they post the job for. So nothing much given. We can just clearly see that there is a mention of premium qualifications, and not really premium because they also are mentioning masters in finance or post graduation in finance, which basically they're saying is MBA, and they are obviously open to hiring freshers, right? So, but given that they are open to hire freshers, it doesn't mean that the interview process is easy, right? So the interview process is divided into three process: online test, okay, which is the gruesome test that they conduct; one face-to-face round, which is again very technical; and then finally the selection, which is happening, right? So now overall, the areas of testing which is covered is aptitude test. Right now, aptitude test is not just focused on those logical reasoning questions. Obviously, they are there, but they also include basic economic questions, valuation questions, and general finance questions. Right now, the tricky part about this interview is not the online test, but actually the technical face-to-face round which is actually conducted. Right, and that is where I want to focus in this video, probably, which will help you in, first of all, getting to know where you stand, and also will help you in understanding how you can increase and improve your preparation, right? So let's look at the first question, straightforward. Okay, in this video, compared to the other videos, I have nothing much more to talk about in terms of the rules, and hence I'm directly getting into the questions. The first question up front in your screen states that impact of spectrum purchase on the financial statement of a telecom company, right? Straightforward. So they are asking you, if a company like Airtel goes and buys an auctions for spectrum, they get the spectrum, what is the impact on financial statements, right? Now, for that, I've written here, I've actually got you can see a screenshot from one of the balance sheets of the company, and so that you understand how this actually works. So what it says is, in case of licenses including spectrum are amortized commencing from the date when the related network is available for intended use in the relevant jurisdiction. Now, you might just say that, okay, it's an intangible asset, so let me just buy it and start amortizing it from year two. But that is where you will get rejected in the interview, because you have to understand the accounting principle states that when you buy the asset, that's not when you actually start amortizing the asset, right? Obviously, it goes to the balance sheet first, but the actual depreciation or amortization. So initially what is happening is when you're actually buying it, okay, so let's say we are buying the spectrum. So in the balance sheet you've got assets, right, and then you've got your liabilities, right? So in the asset side initially, so let me just write initial here. So the asset is going initially to the balance sheet, nothing much is actually happening, right? And this is later, okay. And obviously in the income statement, again initial and later, right? So initially obviously nothing has happening, right? Because why should anything happen? Because you have not started using the asset. Because the entire expensing and revenue matching principle, works on something called as the matching concept. So as soon as I start using the asset, right, that is where the expense should come here, right? So once the spectrum is now getting used, let's say the 5G spectrum, you bought it, right, you auctioned it, and now you got it, and now you're actually selling 5G network facilities. That's when your expense will come, and the depreciation or amortization, for that matter, intangible assets for amortization, will start coming here in terms of an expense. Sorry, in terms of your asset, your value will start going down, right? So that's the basic spectrum effect. Also the useful life range up to 20 years, so that also you should be aware of, that you can depreciate max to max the spectrum of licensing of spectrum up to 20 years. Now what about the revenue share based fee on licenses is charged to the statement in the period of such cost income. So if in case you're not actually buying the spectrum, but let's say you are doing a revenue share basis, you're just buying it for or leasing it out for year on year, then directly charged on the income statement. So that's one of the tricky question. It might not be tricky if you're aware of the accounting principles, but for a lot of candidates this might be new. Okay, another question: impact of land purchased by DFL, okay, on the financial statements, right? The business is to purchase land, make building, and sell the flat, right? Now again, similar to the spectrum question, right, apply the same concept. If you're buying a land but you're not selling it, then it's just going in the balance sheet, right? But as soon as you start developing the land and start selling it, then the amortization and depreciation would come into the income statement. So same principle of spectrum will be applied even in case of DFL for purchase of land, right? Third question. Now again, see, if you see the trend of questions, you are seeing that they are very trying to assess whether you actually understand cause and effect in the financial statements, right? So the third question is: if a pen manufacturing company buys raw material which will be sufficient for use up to 5 years, okay, so all we know is that the company is buying a lot of raw material, right? Then the impact on the financial statement of the above transactions will be what, right? The first is, similar to land, similar to spectrum, it doesn't matter if you're buying a lot of raw material, it will go and it will show up in your balance sheet, right? Of course your cash flow statement will get affected, right? So if I have to write it out here, so let's say we've got our income statement, balance sheet, and our cash flow statement, right? So you're buying a lot of inventory, so of course your asset side, your inventory is going up, right? Obviously you might be paying some amount, right, using maybe cash, or maybe you're getting into credit, but let's suppose that we're using cash, so your cash will go down. Now in the cash flow statement, of course, in your operating cash flow from operating, you will find change in inventory, and change in inventory will show that if, let's say, last year your inventory was 0 and this year it's 500, so obviously the change in invest inventory will give you minus 500, right? Because last year minus this year's value is minus 500, so you basically operating cash flow will go down. But there will be no effect on income statement, because unless and until you're actually selling the asset, right, just selling the finished good, that expense cannot be matched to the income statement, right? So that's the third question. Fourth question: what is deferred revenue? Again understand the same concept. uh, Now obviously not, we are not talking in terms of asset, we are talking in terms of liability, all right? So let's say if a person comes and says that, okay, you know what, I want a magazine subscription, okay, so let's say we are sitting in April of 2023. Okay, and let's say the magazine subscription is about for 5 years. Okay, so there's a 5 years subscription, right? And let's say the company says that, you know what, if you buy the 5 year subscription, you will get a 20% discount. All right, so obviously it's a very enticing deal. So what you do is you go and pay the 5 year subscription as $500. Let's say, okay, so $500 paid. The question is whether you can recognize the entire $500 in your income statement or not. Of course not, right? Because again, the principle of revenue recognition comes in, which states that revenue can be recognized when the risk has been transferred or the service has been rendered. But none of those actually happened. By the end of April 2023, which means the end of financial year and FY24, right, which is March, you will be able to only recognize $100 in the income statement, right? So that would be $100, right? Similarly, in the second year, you will recognize another $100, right? While at the same time, in your balance sheet, right, you have your deferred revenue as a liability, because remember, you are still liable to provide service. So at the end of FY24, your deferred revenue liability will be 400. At the end of FY25, it will be $300, and so on. Right? So that's the impact of deferred revenue on our basic financial statements. Right? Let's move further. Effect of on market capitalization after bonus issue and stock splits. Well, see, market capitalization is number of shares is multiplied by price, right? Now, if let's say there's a bonus issue, all right, let's say you've got, let's say 100 shares are there, and now what I did is I split it. Okay, so I split the shares, and now instead of 100, the same number of stocks are into 200, right? Or maybe this is a split, right? So split into two is to one, and in terms of bonus, let's say we gave similar, right? So 1 is to 1, so again it became 200. Well, in terms of market capitalization, it actually has no effect, but because all that had happened is if 100 shares initially were for, let's say, $50, right? Now since there was a stock split, now 200 shares would be available for 25. So actually it has no effect on market capitalization. Well, it can have an effect on liquidity, although, because if the shares become too in terms of the price, it becomes too much. Let's say the stock price reaches 1 lakh, so that might restrict liquidity, because only one people who want to invest 1 lakh in the share can actually invest in the stock, right? Otherwise people will not approach the stock. Sometimes the company lets that happen to avoid the stock from being volatile, right? But in the longer run it is not sustainable, right? All right. Another accounting questions is, if you are a shopper stop, so let's say you are the owner of shopper stop, then how will you record the entry of a gift card issued? Remember, you've got Amazon gift card, you've got various companies which offer various kinds of gift card. What are the effects of same in P&L, balance sheet, cash? Now I'll tell you two perspectives here. One is, if from an accounting forensics perspective, okay, there have been various cases where in the past, especially in the year end scenario, because you all know that in the year end everybody wants to book higher sales, so that it leads to higher EPS, and then the stock market, it reacts positively, right? But at the same time, there's a lot of crooked companies which will, what will they try to do is they'll try to sell these. If the sales is not getting met, there are a couple of things that they can actually do, but one of those is actually issuing gift cards. So when they issue gift cards, what they say is that, okay, since we have issued the gift card, I will treat it as sales, and this will turn up in my income statement, right? However, there have been so many cases that now not anymore, that is actually recognized as a valid transaction. In fact, there have been a lot of fraud cases in the US where the SEC has not allowed this to happen. So, and principally also doesn't make sense, because you're just giving currency, to a person who has not used the product, because you're not in the business of selling gift cards, you're in the business of selling products. So if I'm giving a $1,000 card of an Amazon gift card, it does not mean that I have sold $1,000 worth of goods. All it means is that I've given transactional value to someone. He can use it later on. So it's just like a credit, right? So that cannot be recognized in P&L as an income, right? Although, how would you treat it in the balance sheet then, right? So let's say we go to the balance sheet now. Now the problem is that we have received cash, right? So obviously the cash will go up. The problem is, do I recognize it as an asset or do I recognize it as a liability? Well, the problem is here again, you can treat this very similar to deferred revenue, because again, he has taken the shopper's card, $1,000, but you've not provided him service. So in reality, you should actually record it as deferred revenue. And from an accounting, forensics perspective, you should actually be or very alert for such transactions, because that's not really a good practice, and you have to look at deferred revenue whether it's increasing too much. That might be a sign that the company is aggressively trying to increase sales. Okay, let's move to the next question. Okay, next question is, why should I pay for the debt if I want to acquire the company? I can straight away purchase the shares of the company for acquisition. That's a common question when people are faced with, do I pay for enterprise value or do I pay for equity, right? So if you look at the formula for EV, it is market capitalization plus debt minus cash, right? And then that's basically equal to EV. If you look at the other way around, market cap or equity is EV minus debt plus cash, right? Now think logically, when you are purchasing, let's say 100 shares of a stock, obviously you go to the exchange, right, and you purchase, let's say, 100 to 200 shares, right? Let's say I tell you that the float, okay, so float basically means the amount of shares which are actually available to purchase. Remember, not 100% is available. As per SEBI, 25% is the minimum float which is required to the market so that retail investors can buy. Okay, if the float reduces by 25%, then the stock gets delisted. Hence, and typically you will find companies will not have 100% float in the market. So if you want to acquire the company, first of all, the question is, do you have enough stock to purchase in the exchange to actually take control? Probably not. So that would mean that you will have to acquire the entire company, also acquire the one which is not in float, which is held by the promoter. Now, in that case, basically, you are acquiring the entire company. Now, think about that when you are acquiring the company, what value are you paying? Right? Because when you are acquiring the company, you are also taking the liabilities of the company. Right? You cannot just say that I'm just going to take the good part of the company. I have to take obviously the liability part of the company also, right? And at the same time, it's a good thing that you can also use the cash which the company has it on its balance sheet in terms of investments, in terms of inventory, whatever, cash and cash equivalents, to reduce the debt. So you basically are saying net debt, right? So whatever debt minus whatever cash the company has, and that's exactly what you're actually paying for the company. So you're not exactly paying for the debt. In reality, you are acquiring the company, and hence when you're acquiring the company, you're also acquiring the liabilities of the company, but you're reducing the liabilities of the company using whatever the asset based cash the company is holding in their balance sheet, right? So that's the next question. Now let's do, how will you do the valuation for Kolkata Knight Riders? Well, very simple. Whether it's Kolkata Knight Riders or whether it is any other entity, valuation basically depends only on one thing and one thing only, which is free cash flow. right? Because at the face of it, when you're looking at Kolkata Knight Riders, you're looking at players. You're looking at Shah Rukh Khan, you're looking all that glamour. But behind every business, there's nothing but called as free cash flow, right? So you are saying what is the company generating as revenue today? What will be the revenue generated in the future? Now you might ask that there are auctioning that happens and players get sold, of course, and that is also revenue. So your approach to valuation for Kolkata Knight Riders would be nothing but the projection of revenue and cash flow for the future and discounting it back to the present, and that would be the uh, valuation of your sports company, right? Let's look at the next question. How are the share split and bonus similar? Well, in terms of the effect, it is pretty similar. In terms of the intent, there might be difference, right? Share splits are generally done, as I said in the previous slides, they're done majorly to increase the liquidity. Bonus can be a tactic by the company to impress the shareholders by saying that, okay, you had one share, now you have two shares, right? So that's the only difference. What is impairment of goodwill? So again, a lot of people don't even know what is goodwill. But whenever you are acquiring a company, let's say we are acquiring Baiju, all right, and let's say the company that is acquiring is ours, is ABC. Now let's say the net assets, okay, of Baiju is, let's say, 600 million dollars, right? So that's the book value net assets of the company. Now we get into negotiation to buy Baiju, and we end up at the negotiation level, we end up paying, let's say, 1000 or 1 billion million dollars, right? Now when we are acquiring this company, there's a difference of how much? 400 million, which we paid extra, right? So in the balance sheet of ABC, which is ours, when we acquired the company, we obviously paid slightly higher, right? Which means that in our balance sheet, the goodwill will be mentioned as $400 million. Now the problem is, what if, so let's say this is 2023 and the market was in a bull run and everything was good and everybody was happy and the euphoria was there, so we paid a little extra. Let's say 2024, the edtech market crashed, and obviously panic came in. And now every year when we are testing for impairment, we realized that the valuation now of Baiju is, let's say, minus 500, or let's say plus $500 million. So there's a loss of $100 million. That means in our balance sheet, we will have to reduce the value of Baiju's acquisition. That is nothing but called as impairment of goodwill. Because, and usually if you are seeing a lot of impairment of goodwill in the balance sheet of any company, you should automatically derive that the company is reckless about its acquisitions. Because companies generally acquire to boost their revenue very easily, right? Because you acquire let's say ABC had $100 as revenue, Baiju has $100, so very easy to increase the revenue. It's just to add 100 plus 100 is equal to 200. But at the same time, you might end up paying more than what the value of the company actually is, right? So that is goodwill impairment, and that brings us to the end of some of the questions which I felt will invariably come in your transfer value interview. And a sense of, if you were to get a sense of what kind of questions actually come, so they are very very specific in terms of financial statements, right? You can see that the questions are not very shallow in terms of financial statements. They're very getting into very specific accounting principle. So if you want to crack this interview, then my suggestion would be to digging deeper in terms of financial standards and how these specific balance sheet items, revenue recognition principle, expense recognition principles, and also a bit of valuation, how does that work in a very very deep manner. And I think that will help you in cracking this interview in a breeze. Right? So I'll catch you up with you with another interview preparation video, and next week I'll see you again. Bye bye.